This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusoya. Welcome to the show. For many clients, their property is the second biggest, if not the biggest, asset that they have. My guest today believes that this asset is underused in the retirement planning process and is on a mission to change that. Roland White, CEO of Knuckle, welcome to the show.
Thank you very much. I think already you've done a lot of the hard work for me in getting the message across, because that's exactly the mission that we're on, is the way in which we integrate property into financial planning and helping consumers make the right and the best decisions. And maybe just what underpins that, it's the importance of looking at all of your assets. So whilst, property is something I have a particular passion for, as you mentioned, it's a large asset that sits within holistic wealth. And if you keep on coming back to the same philosophy that we totally believe in, which is people make the best decisions if they can see all of their assets in a single place, and property is an important one.
So we'll dive into all of the reasons why and the challenges around doing that. But let's talk a little bit about you. Give us a sense of your career and how what the journey that led you to creating Knuckle.
It's a good question, and it's certainly been a journey. Yeah. So I started my career in accountancy, actually. I was one of the many people who at university, what shall I do with my life? And I couldn't quite work out what I wanted to do. So
you didn't know what you were going to do at uni?
No,
I'm joking.
And it became let's take an interim step. Let's do something. So numbers have always played a role in my life. That's really the accountancy bit. And then I moved to investment banking. I moved to HSBC. I had a good time there. This was really around wealth management. Eventually, I ended up becoming the head of asset wealth management advisory globally. Fascinating period of time to get all the different perspectives from different countries and regions. So I had a bit of wealth, bit of accountancy. I then moved to FNZ. I wanted to do a little bit of tech. Gosh, that would have been back in 2019. But I've always had passion for property. So the career, if you like, was all the way through with a bit of wealth, a bit of property, and a bit of tech. And Knuckle was born.
You talk about the problem that you're trying to solve, which is how you bring property into the financial planning process as part of the overall wealth of the client. Why?
I was hoping you were going to ask me that question. I'm going to try and answer it with a few stats, just to try and help bring it to life. So stat number one, so roughly 80% of property wealth is owned by individuals over the age of 50. So those in or approaching retirement. And there's about 2.6 trillion of wealth, of value of properties that exists for people in retirement. That applies to people who are over the age of 65. Now, if you think that of that 2.6, 2 trillion is a owned property that has no mortgage, that's pure wealth. Whilst we, clearly a house, your home, it's much more than just a financial asset, but that's a significant number. And when you put that into the context of a, retirement income gap of 50 billion per annum, and on the other side, this, sheer size and scale of property wealth, and then track it through to someone's estate ultimately, then the number or the proportion of someone's wealth increases as they draw down on their pensions. Naturally, it takes you somewhere closer to 70%. So you've got this huge amount of wealth that, whether it's from an intergenerational transfer, tax planning, quite frankly, enjoying retirement, the problem we're really trying to solve here, or help solve, or equip the user and ultimately the consumer, is to understand and recognize just how large a component of wealth exists. So there's a real educational factor in here that I'm sure most people have a sense on how much their property is worth, but they probably haven't thought about, when they're reaching that decumulation phase of their life, how that asset can be brought into financial planning And if the objective is to turn everything on its head and say, well, I have this wealth, all of my assets, how do I have the best retirement? I want to leave something to the kids, but I want to enjoy retirement. And there are lots of different ways that you can bring property into that conversation to support that really important objective.
So many financial planners will say, hang on, we do take property into consideration. We do take information about a client's property asset, or indeed all of their assets and mortgage, but we can't do anything about it. It's an asset and it's sitting there. How do we do that? How do we actually use it? Yes.
Yeah. So it's a really interesting observation, because a lot of the feedback we've had when we've been developing Knockle is, but we already have this information. Why do we need more of the information? And I think that the consistent theme that has come out of that is actually all the information exists through fact finds, and advisors know, they know their clients, their properties. What they struggle with is the ability to keep track of information. And when I say information, I mean things like, actually, if your house happens to be in a particular area, school catchment area, the property value can change dramatically. You'll only find that out when you go through a fact find process and check on Zoopla. Or what we're doing is not trying to, replace what advisors are doing, but actually through automation, equip them with the ability to track property wealth in the same way you would track your investments. So when it comes to making a decision, then what we're really providing is the latest information. But we go one step further than that, and this isn't unique to property and to Knockle, but there's a growing pool of data around property, which we tap into. In fact, the first couple of years of creating Knockle was really about understanding what data exists. That's really valuable data in a consolidated way for the advisor to help them do their job. So I guess point number one is you can see the latest property wealth that someone has. So that's valuation less mortgage. So we track and automate both of those. But the second point is you've got all this data that actually might trigger a really important life event or advice discussion. So that could be that someone's moved through a loan to value threshold and there could be a better mortgage. Someone probably hasn't saved enough for their retirement, but they live in a very large house. Well, maybe there's an opportunity to unlock some of that wealth, whether it's downsizing, whether it's through releasing, unlocking some equity, or someone has an investment property that they've put on the market. So we can track that data. Now, if they've put their investment property on the market, what are they going to do with all that money, with all the funds? So it's really sort of helping or using data to help create the eyes and ears for the advisor, so that they can help them do a better job. And the third thing that we do is we take it one step further. So once you surface this advice opportunity, we're building calculators and tools that help the advisor have a conversation with their client to better understand their options in relation to property-rated products and solutions. So that's mortgages, equity release, life and protection, and insurance. If you know when someone's bought their house, you generally know when their insurance is up for renewal. There's a real opportunity to sort of bring in solutions off the back of ultimately property data and start understanding someone's property profile and their home through our platform.
So let's talk about what you've done so far. As I understand this, a big part of this process is how you automate or digitize that process of, collecting data and tracking data about the property. So what is it that you've actually done from a technology point of view?
We've built an advisor dashboard,
right,
at the very heart of everything we're doing, and ultimately consolidating all this data. It comes down to two core components. One is very simply a property profile. You have a Facebook profile, you have a LinkedIn profile. This is a property profile. So that has some very basic information, but importantly, it includes a picture of your property. Now, how many financial assets can you physically see? Now, let's put wine and cars to one side, but there's a real engagement factor to property. People talk about it at dinner with friends and family. They don't talk about their pension. So there's a real engagement factor with the property profiles. So that's the first part. The second part is the advisor dashboard I mentioned, which is really a consolidation of all of the advisor's clients so that they can see and scan and see nudges, alerts when something's happened in their client's property that might warrant a discussion. So the dashboard and the property profiles, that's what we're integrating into financial advisor platforms. But the same components through API links are available for a direct or a consumer proposition. And logically, you can keep on going with that to other places, including workplace, private banking. So it's really sort of moving across the channels. And in each case, the user case is slightly different, but the fundamentals are the same, that, we all or most people own property, and we only really spend time on it when we're buying or selling, or if we're going through a remortgage. Well, they don't happen that often. So this is about bringing property into more of a day-to-day perspective. And I hope you have no family members who are estate agents when I make this comment, but would you rather that a financial advisor is giving you advice on your property or an estate agent? And you don't have to answer that question depending on, family members and friends, but I know which one I would prefer.
Yeah, I think this feeds into the theme that we're seeing already with financial planning, which is that the direction of travel is towards that holistic view of the client's wealth, not just, investments or pensions. So some of the work that I've seen some of the demo of this a couple of months ago. I'm sure it's improved or progressed significantly since then, which is integrating that property asset into the advisor platform to let them see that asset as part of the overall wealth of the clients.
Absolutely. And that takes us back to, I guess, the conversation we're having right at the very beginning, and the philosophy that, people make the best decisions if they can see all the information in front of them. And if you're making a decision around your drawdown strategy, well, knowing all the ingredients that you might have, what is a really important discussion and ultimately decision is the right thing to do. And given the sheer size, scale of property, that's the logic behind the integration into a perspective of holistic wealth. I think it's probably important to say alongside that in some ways, obviously it's different because you can see the asset, but it's also, we need to respect the fact that it's an emotive asset too, and the usual metrics you might apply to buying and selling funds and constructing portfolios doesn't always apply to property. It's more of an art than a science, but you still come back to, well, if you're going to make those decisions, then let's make sure you can see all of your assets, including one of your largest.
Yeah, I do see the value in having the insights so that it's sitting alongside, let's just say on your household balance sheet, and you can get up-to-date information about it and alert. I get the value of that. But as you say, 2 trillion of property wealth is sitting without mortgages on them. And most of this is in the hands of over 50s, over 55s, so people in or approaching retirement. I guess the challenge I'm thinking about from a financial planner's point of view is, yes, we get the value of having the information and the data, thinking about how that might fit into your, let's say, retirement or decumulation strategy. But when it comes to implementing, the options really are, do you downsize? If you do need to use some of this wealth as part of the plan, do you downsize? I sell the property and buy something smaller or in a different area or whatever. And I don't know that financial planners get too involved in that process, maybe in the decision-making process, yes, but, once that decision is made, it's up to the client to execute. Correct me if I'm wrong. I have been wrong a few times, and people tell. And then the other option is, do we go into some sort of use debt, equity release, remortgages, something along this, And two challenges I think about. One is that, first, from a regulatory point of view, financial planners tend not to hold the kind of the regulatory permissions that you need to do these sort of things. So mortgages, a completely different line of regulation and thinking for financial planners. So there is that one. And then secondly, this perception, maybe reality, that people just don't want to, financial planners just, or clients perceive, equity release, for instance, as kind of grubby. We don't want to get into that. There is all sorts of risk for the client. How are you thinking about this challenge?
That's a really, really good question, and one that we've spent a lot of time thinking through, and well, not just thinking through, but doing something about it. And maybe before I try and answer the question, again, big picture philosophy that I think we need to find a way to break through is that as a nation, we don't like debt. And success has always been, I want to pay down my mortgage, I've achieved success, I can retire, I don't have to worry about my mortgage. That's the definition of success for an individual. It's also the definition of success for the taxman, because guess what? 40% of that above a threshold is going to be paid in tax. And I think that's the perspective and the angle, particularly when we think about intergenerational transfer and other problems as well. So kids struggling to get onto the ladder. The average age every time I check seems to have moved up another year. So this whole intergenerational transfer, how do you, I want to stay in my home, but I want to help my kids. I don't want to hand over, all of this wealth to the taxman. There's some real problems to solve. And I think, unfortunately, with equity release, it does have a history, and that history exists because it's often thought about as a tool for the last resort.
Yeah.
And because a lot of that business is originated through that segment of the market, I don't think it's really been factored in and considered as a tool for financial planning. But the point you make is a really important one, and that is most financial advisors don't have the permissions to advise on equity release. So how do you solve that? Because great, we can give them the property wealth details, but they can't advise on equity release, then what's the answer? So as part of our solution, we recognize that and are linking through or equipping the advisor to understand enough about, and this is the calculators and the tools, we call them modules,
right.
To help the advisor understand. So it's education for the advisor. In theory, how much wealth can my client unlock from their property? And not just, well, what's the cost of it, but what is the impact on the estate? The question is not about how does this price compare to another mortgage. The question is, I want to have a conversation with my family about this, and I can withdraw £200,000, which I might be pulling from my pension. I can pull it here, and this is the impact it's going to have on the estate that I'm going to hand over to you kids. That's the conversation that a financial advisor, I think, needs help with, to be equipped with, not to go through the process of, I'm now going to go through a full fact find to assess equity release as a product. But if you can help the advisor understand what the potential is, then the appropriate person can have that conversation. So I think it really is about embedding education into, here's my property profile, this is what I can do with my property wealth. By bringing all of that to life, we're then helping the advisor help their client make the best decisions possible without asking the advisor to do more than they want to do. They're already far too busy, and sort of asking all advisors to suddenly get permissions. The same for mortgages too. Most financial advisors won't advise on mortgages for good reason. But if you can tell them that their client's mortgage is coming to an end in 3 months' time, which could have a cash flow implication, so relevant for the financial advisor and a financial planning conversation. But if they have a referral partner, and there's a good relationship there, or if not, we can help find one, then that feels like a good ecosystem to help construct through technology.
That's interesting. So I think I can get a glimpse to how you're thinking as an entrepreneur around this, which is it there somewhere in the Knuckles, global domination plan that you will, via your platform, advisors may be able to find partners that they can refer clients to for the implementation, if that is the right direction for the client.
That's the right and logical thing to do. So that's a good observation.
Okay, you're not going to give me any more than that. There was something else I wanted to ask you before we start to wrap this up, which was there's been some research done in the US around how you can use, they call it, so this is around retirement and decumulation research. And in the US, there is this concept of HELOC, I think it's called, home equity loan, which essentially allows you to create a line of credit on the property, but you don't actually draw it down. And when you see the modeling, some of the modeling of this, the idea is that you essentially create a line of credit on the property, and that it's just sitting there. You agree the facility, you agree the interest rate and all the cost and all that stuff, but it's sitting there and it's used as a device to avoid or to dampen the impact of sequence risk on your retirement portfolio, which means that if you are drawing from your portfolio and you hit a really difficult market condition, then you can maybe pause the withdrawal on the portfolio only temporarily to allow the portfolio to recover, and then draw down some of the line of credit that's been created on the property for a time, and then come back. I mean, and I remember having a conversation, I read this research in the US and really interesting stuff. I think the numbers might have changed more recently with interest rates and all that stuff, but I haven't looked at it. And I remember having a conversation with a big bank in the UK where they were talking about really leaning into this. But all of this, as far as I am aware, haven't really gone anywhere. Do you see this as a possible option on the table down the line? Is there any merit to it, or am I getting too...
Well, you mentioned we were sort of heading towards wrapping up, but you just picked a topic that I could spend another couple of hours.
Please, go ahead. It's my podcast after all. I can do whatever I want.
You might lose a few listeners. The fundamental point that you've uncovered is that unlike most investments, property is illiquid. And that's the fundamental problem, is your route to creating liquidity in property is you could downsize, you could sell the property. It's obviously a very lengthy and uncertain process, and it has implications given most people tend to live in their property. So the question is how do you create that liquidity? And we've talked about equity release and mortgages. I mean, really the only difference between the two is one is a lending facility when you're earning money and is secured on the salary that you generate, and the other one is secured on the property and rolls up the interest. It's just a reconstruction of a lending facility. The same with the example that you gave in the US. So I think the fundamental problem that we're trying to solve, and today we have to look at existing products and solutions and work with those, is really the mortgage or equity release. But if you trace all of that back, actually, it comes back to the same theme, the one you mentioned at the start, which is holistic wealth. So if you look at all the assets together, what is the optimal outcome for the consumer using the different assets and the different levers you can pull? So again, for equity release, you don't have to on day one draw down an entire facility. It can very easily be, well, I want a facility for 200,000, 500,000, depends on the value of the property and what you want to do. And of course, there are fees involved in that, but you don't have to draw down the facility. So actually, there's real value in having that liquidity, that when you look at the overarching picture of your financial assets, all of them, there may be a better way. So a lot of this just comes back to, in order to make the best decisions, obviously holistic wealth, we talked about that a lot, but also equipping and helping the advisor understand what tools they have available for them. And the liquidity point, until the day that we can tokenize property, which, maybe we'll do that in the next podcast. Until we get to that point, the liquidity has to come from a lending facility of some description, and it will be different in different markets, but it's the same fundamental problem to solve.
this idea of the role of the financial planner or advisor evolving and being the management of the client's holistic wealth, whether that wealth is sitting in property or in investments or in pensions, to help clients achieve their own objective is very fascinating. And to think about all of these things as tools to help people achieve the life that they want, I find it really, really exciting. And some of these things can make far bigger impact. You know, we tend to obsess about basis point difference in terms of outperformance of portfolios relative to market, but actually you can make 40% difference to the client by, for instance, optimizing for inheritance tax or other taxes, and bigger impact, for instance, by using frameworks to dampen the impact of sequence risk in their portfolio. I'm excited by what all of this brings, and it's great to see the work that you guys are doing in that space. So maybe you want to speak to the future, your parting words, whatever you want to leave our audience with, feel free.
Now's my chance.
Now's your chance.
Well, I wasn't expecting that question, but so this is completely off the cuff. But I just think it's a real opportunity. I'm sure everyone enjoys the benefits of accumulating wealth over the lifespan and the decumulation phases as well. The overriding message is don't forget about your property. It's important. It's the first thing that you save to buy. It's the place that you live in and enjoy, you bring up your family, but it's also the place where if you get the financial infrastructure right, it's an opportunity as well to really enjoy retirement. And that's probably the departing messages. Don't forget about it as a financial asset as well as an emotive asset. And that's something we want to help bring to life and help advisors help their clients bring to life as well and solve all the problems we've been talking about.
That's good. Tell us a little bit about where we can find more information about Knuckle. I know you wrote a paper a while ago. Where can we find?
You can find it on our website, so www.knuckle.com. We're just going through our website refresh, so give us maybe a month, and then we'll have the new revamped version. That's probably the best place to come and find us. If anybody ever wants to have a conversation, we're always open to learning more, particularly within the advisor community. If anybody has interest and to join, sort of our group of advisors that test the product and have a chance to preview and play around, we'd love to hear from you and just generally keep in touch.
Well, Long White, thank you for your time. Thank you for coming on the podcast.
Thank you very much. It's been a pleasure.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.